Hello, I'm Sabina CPA. I advocate less taxes and more profits. Today, I'd like to talk about year-end tax planning. Procrastination is easy, especially when it comes to tax planning. There have been many tax changes in 2020. Despite past, present, and future changes to the tax rules, some year-end tax planning advice remains unwavering. Here are a few time-tested suggestions, along with practical tips on the new tax law passed earlier this year. We hope this will help jumpstart your year-end review. Number one is make adjustment to withholdings, estimated tax payments, and income collection. If you haven't already, update your withholdings and estimated tax payments to reflect any changes needed since last year. Updates may be in order if you experience a big life event such as marriage, divorce, or a new job. Overpaying your 2020 tax reduces the cash you have on hand throughout the year, but underpaying can lead to penalty and interest. So what you need to do first is to prepare a Form W-4 and do a paycheck checkup to make sure income tax withholding are accurate. To the extent possible, think about deferring income and accelerating deductions and expenses to reduce tax liability for 2020. See if a year-end bonus can be paid in the 2021 and hold off exercising incentive stock option until after year-end. Second tip is to maximize retirement plan contributions. You have heard this advice many times because it's one of the best strategies for saving tax dollars, especially when wages are your primary source of income. When inflation adjustments kicks in at the beginning of the year, did you boost your retirement plan contribution? If not, you still have time now to increase your contribution over the remainder of 2020. Elective deferral for 401k and equivalent. Contribution can be deducted and the earnings on the contribution grow tax-free until the money is distributed from the plan. Sometimes the employer even provides matching funds, which is essentially ex-pay to you. So boost pre-tax contribution prior to year-end to reduce your income. IRA plans. Contribution to traditional IRAs are tax deductible, and the earnings grow tax-free until the money is withdraw from the plan. Contribution to Roth IRA are not deductible, but the earning and distribution are fully tax-free. Contribution to this retirement plan can be made up until the due date of the tax return, which is April 15 of next year. What you need to do. For 2020, you can deposit up to $19,500 in your 401k, $13,500 into Simple, or $6,000 into your IRA. If you're 50 or older, with additional catch-up contribution, you can contribute a maximum of $26,000, $20,000, and $7,000, respectively, because the catch-up limitation are $6,500, $6,500, and $1,000. You can contribute to both a 401k and an IRA, though tax deductibility on IRA contribution may be limited, depending on your income. If you can't manage the entire amount, try to contribute enough to take full advantage of any matching contribution offered by your employer. Again, this is essentially extra pay you can get. Take a look at our Best Retirement Plan Part 1, Part 2, and Part 3 for more information on our website at basecpaplus.com. There's something special in 2020 that only happens this year. There's no age limit for contributing to your IRA. You can now contribute to an IRA regardless of your age, as long as you have earned income. The old rule prevented you from contributing to an IRA past age 70 and a half. The IRA contribution limit for 2020 is $6,000 if you're under age 50 and $7,000 if you're age 50 and over. So between now and year-end, consider getting a part-time job or doing some consulting work now if you won't have earned income by the end of 2020. You can then use this earned income to fund your traditional or Roth IRA. The third tip for tax year planning is be tax smart with retirement distribution. If you need to withdraw money from a retirement plan and have some flexibility, work with a tax advisor to figure out the more favorable tax impact of taking the distribution this year, next year, or by spreading them over 2 years. Keep in mind, even if you don't have a required minimum distribution yet, removing a planned amount from your retirement account each year may be more tax efficient than waiting until you are required to do so. So what do you need to do? Take your required minimum distribution. If you're required to take distribution from your retirement plan, do so by December 31st, or you face a 50% penalty. If you just turned 70 and a half this year, you can wait until April 1st, 2021 to take a first distribution. Consider charitable contribution. If you're age 70 and a half or older and hold an IRA account, you may be able to benefit by making a qualified charitable distribution to possibly reduce your above-the-line income. In addition, with a donor-advised fund, you receive an immediate tax deduction and the right to recommend grants from the fund over time. Only in 2020, you can use retirement saving to pay for birth or adoption expenses. But adding a child to your family is very expensive. To help with this cost, you can now cash out to $5,000 per parent from your retirement account to pay for birth and or adoption expenses. While the withdrawal won't be hit with a 10% early withdrawal penalty, you will still have to pay income tax on the distribution. So consult your financial advisor or benefit coordinator to find out how to withdraw the fund from your retirement account. Since the withdrawal will deplete your retirement savings, first consider whether you have other sources of cash to cover expenses. The fourth tip for year-end planning is to deploy a gift-giving strategy. It's time to work on your 2020 gifting plan if you haven't started yet. As you plan, remember you can make gifts up to $15,000 in 2020 as a single person or $30,000 as a couple to any number of recipients without having to pay gift tax or file a gift tax return. This could include gifts of cash or property, including investment. If you decide to give money to a child or grandchild for education expenses, the $15,000 per person annual gift limitation does not apply if the payment is made directly to a qualifying educational institution. Not only are gift tax limitations removed, making substantial education payment in this manner could also reduce your taxable estate, ultimately reducing your exposure to estate tax. Don't forget that your direct education gift can be for a grandchild, niece, nephew, or anybody else of any age, either related or unrelated. So what you need to do now is to consider gifting direct education gifts to recipients who would benefit from your generosity. The fifth tip is consider the new kiddie tax rule. If your school-aged child works, recent changes to how their unearned income is taxed may mean you'll be dealing with higher tax rate. The tax is now based on the rates of estate and trust instead of parents' top tax rate. So your child's unearned income tax rate gets much higher much sooner than in prior years when it could be taxed at parents' lower rate. What you need to do now: be careful with transferring income-generating investment to your child. The best way to avoid a higher tax rate is to manage your child's unearned income at or below $2,200 for this year, which is 2020. We will continue with the next 7 tips for last-minute tax planning before year-end in our next tutorial. If you find this video useful, please click on like, subscribe, and forward to those who may also benefit from this tutorial. Please also head to basecpaplus.com to sign up for our email newsletter full of tips for less taxes and more profits. Until next time, God bless.